Market manipulation. It sounds like something out of a financial thriller, but it's very real, and it happens more often than you might think. From shady penny stock promotions to high-frequency spoofing, these tactics distort markets and damage trust in the financial system. In this video, we'll break down some of the most common forms of market manipulation, how they work, and how regulators try to catch them. By the end, you'll understand not just what these tactics are, but why they're so tempting and dangerous. What is market manipulation? Market manipulation refers to deliberate actions aimed at deceiving investors by artificially inflating or deflating the price of a security. These tactics can mislead traders into making decisions based on false or manipulated data, whether that's buying a stock that looks like it's booming or selling one that appears to be crashing. Manipulation can be done by individuals, trading groups, or even firms. While it's illegal in most regulated markets, the rise of digital trading and social media has made these tactics easier to hide and harder to trace. That's part of why you still hear about them, even in today's supposedly transparent markets. The motivations vary: profit, influence, or even revenge. But the result is always the same: someone else gets burned. And that's why financial watchdogs like the SEC and FINRA take these tactics so seriously. Pump and dump schemes. Let's start with one of the oldest and most infamous tactics, the pump and dump. This involves artificially inflating the price of a low-value stock through false or misleading statements, often hyped up in chat rooms, social media, or email blasts, and then selling off those shares once the price spikes. The pump is all about creating hype. This penny stock is the next Amazon. Once retail investors jump in, driving the price up, the original promoters dump their shares at the top. The price collapses, and everyone who bought in late is left holding the bag. These schemes are especially common in low-liquidity stocks, usually on the OTC markets, where even small amounts of trading can move prices dramatically. Some crypto coins have also seen similar tactics. Regulators have cracked down on these over the years, but with new platforms and influencers entering the space, they're far from dead. Spoofing and layering. Spoofing is a more sophisticated form of manipulation that usually occurs in high-frequency trading. Here's how it works. A trader places a large order they have no intention of executing, just to create the illusion of demand or supply. This fools other traders into reacting, buying or selling, based on that fake order book data. Once the market moves in the desired direction, the spoofer cancels the fake order and profits from the shift. Spoofing can happen in milliseconds, which makes it hard to detect without advanced surveillance systems. Once the market moves in the desired direction, the spoofer cancels the fake order and profits from the shift. Spoofing can happen in milliseconds, which makes it hard to detect without advanced surveillance systems. A variation called layering involves placing multiple fake orders at different price levels to create a more convincing illusion. These tactics have led to multi-million-dollar fines for big firms and individual traders alike. Notably, the 2010 flash crash was partially attributed to spoofing activity, showing just how dangerous it can be at scale. Front-running and insider abuse. Another common tactic is front-running, when a broker or trader uses advanced knowledge of a client's large order to place their own trades first. For example, if a client is about to buy 1 million shares of a stock, the trader might buy ahead, knowing the price will rise. Once the client's order pushes the stock up, the front-runner sells at a profit. This kind of behavior is a breach of trust and illegal in most jurisdictions. It's particularly damaging because it uses privileged information not available to the public. And while it's often hard to prove, regulators have brought high-profile cases, especially when evidence comes from chat logs or internal emails. Closely related is insider trading, buying or selling securities based on non-public material information. While not all insider knowledge counts as manipulation, when it's used to distort the market before the public has access, it's definitely crossing a line. Why it still happens, and how regulators fight back. You might be wondering, with all this scrutiny, why do traders still try these tactics? The answer comes down to technology, complexity, and risk-reward calculations. In fast-moving markets, especially where anonymity is easy to maintain, manipulators often feel one step ahead of enforcement. To combat this, regulators use advanced surveillance tools, machine learning algorithms, and whistleblower programs. The SEC, for instance, has a market abuse unit specifically focused on manipulative behavior. There are also hefty fines and criminal penalties, but catching and proving intent can still be a challenge. Education is one of the best defenses. The more investors and aspiring finance professionals understand how manipulation works, the harder it becomes for bad actors to exploit the system. Market manipulation isn't just a problem for regulators. It affects everyday investors, professionals, and the integrity of the financial system. From old-school pump and dumps to high-tech spoofing, these tactics evolve with the times. But understanding them is the first step to spotting and avoiding them. If you found this breakdown helpful, make sure to like this video and subscribe to Working Finance for more real-world finance insights every week. Got a topic you want us to cover next? Drop it in the comments.